Guys, welcome back to PowerPoint slide presentation number 3. And in today's PowerPoint slide presentation, we're going to be going through the trading chart patterns, okay? There's a lot of information in this video, so stick along for the whole thing. And also, there may or may not be a webcam posted up here, so if there isn't, that means I had some technical difficulties, but if there is, maybe I'll stick around and keep on doing this more often. I don't know. We'll see what happens. But yeah, so let's just jump right into it. There's a lot of information we have to cover today. And let's start it off with the basics, which is support and resistance. You might have heard these terms before, but let's dive deep into the actual definitions of these. Okay, support is a price level where a downtrending stock stops due to demand of buying interest. As the price decreases, interest in buyers increase, causing the formation of a support line around this area. So when you see a stock falling, okay, and it keeps on going down and down and down, eventually it stops near an area. It may be an area similar to where it stopped before, and that's because it's an area of support. That is the bottom line. That's our support. That's our heavy support area where we want to buy stocks. Now, resistance. Resistance is a price level where an uptrending stock stops due to a demand of selling interest. As the price increases, interest in sellers increase, causing the formation of a resistance line around this area. So as a price keeps on moving higher and higher and higher, eventually it's going to stop somewhere. And if it's near an area of resistance, there's more interest in selling that to take profits rather than buy into it, causing that resistance area and that roof of an area where the price will then start to fall after. But let's look at some charts and see what we're actually dealing with here. So to map it out, it looks really simple, and it really is once you get the hang of it, okay? Support here is on the bottom. You can see there's 4 areas of where it touched support, but this whole line right here would be support, so anytime the price comes down to this area, you would consider buying it. Now up here is our resistance line where it was touched twice, okay? So let's go along with this chart. Let's say our stock right here on this day is trading right here at this candlestick. We follow it, okay? It bounces right here near the support level, and we buy in near support. We let it ride up, ride up, ride up, ride up, and then we get close to this resistance area, so we look to sell out of it. Now, we can trade this stock completely off of just support and resistance, okay? Now, the stock starts to fall back down because it hits that roof of resistance. Boom, 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 all the way down to support. When it touches support, let's buy into it because it's near support, and it's done this in the past, so let's see if it can do it again. Boom, it takes off, moves to the upside again, touches resistance, sell out near resistance, boom, all the way down to support again, buy near support. Now right here, it did reject down in this resistance area right here, which as you can see would be support, but we'll get into that later. And it rejected back down, but it touched support again, so therefore we're still in a position. So obviously if you bought any time really at support, you would sell at resistance and make a profit, okay? But let's go through support and resistance on another chart that seems a little bit more complicated, and we actually have a breakout pattern. So you would take you look at the stock, okay? Down here we see these candlesticks, and they're forming. We break above this support level right here, okay? And we break out and we touch this resistance level, our first resistance area, and we bounce to the downside. Then we touch support again in this area, and you could enter in any of these candlesticks because they're all very close to support, and it bounces and runs up to the upside or near resistance. So now we have twice a hit of resistance here, okay? So that means once it's tested twice with support and resistance, that means it's confirmed, okay? So it's resistance again, bounces down, touches support. Now because we've already touched support once and twice here, I would take a position here at support and let it ride up. But watch what happens here. Instead of it getting rejected to the downside on resistance, it breaks through and above, which happens a lot of time, and that's what's called a breakout. So when the stocks are about to break out because it's previous resistance and it gets enough momentum to break out to the upside, you want to hold that position or take a trade for a breakout. So we bought down here to support, so we're fine and dandy. We hold through resistance. We're still trading higher. We haven't got tested yet. Now, because we did break out, I would probably take some profits up here because we broke out of resistance. Who knows how long it could stay? It may not stay. It may fall back to the downside and below it. So we'll take some profits out. But guess what happens here? This resistance level is now flipped to support because after we broke out of resistance, boom, 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 we went back down and tested it as a support. Now that it's support, okay, it bounced off this area and now is moving higher to the upside. So we're still in the position because we never got validated out and never broke down below resistance, which is now support. So therefore, we left the position keep on riding, and there you go, resistance and support. Past resistance is future support, okay? and boom, right here. Previous resistance is new support, is what I have it titled right here. Same concept right here. The stock trades inside of this channel pattern right here with resistance and support. Support, resistance, support, resistance, support. Breaks out like it did before, and remember it said it flips? It does. Now this line right here becomes support, because guess what? It touches it as support, bounces new resistance, touches the support, bounces new resistance, touches support, bounces new resistance, and actually breaks out again. So this actually, if it bounced here, this would turn into support. So every single time a stock runs through resistance area, falls back down, hits that resistance, and now turns to support. And that's what we see right here with this chart pattern. So you can look now at more of a channel up, and channel down, because we know our support and resistance areas. So what is a trading channel? A channel drawn on a chart by graphing two parallel lines, which would be the support and the resistance. Within the channel, you look to buy at the channel support and sell at the channel resistance. Okay, so like we've basically been going through different channel patterns. But this would be more of a channel up pattern, which means that overall the stock has a resistance and support, but it's in an overall uptrend. So if we bought any time near these support levels, you would have made a profit. But overall, the stock is still in an uptrend. So even near these resistance levels, it gets rejected down, and we buy again, and it moves even higher. Breaks out of these resistance areas, moves again higher, moves down, moves higher. So this is an uptrending channel up pattern. This means that overall, the stock is in an uptrend, has this resistance line right here where you would still sell out at, but has a nice support area where you can buy in it also, and it keeps an uptrend. So this is very, very important to keep watching for, because a lot of stocks that are in bullish upward momentum use these channel up patterns to trade off of. You could literally just buy in here and let it ride up because of the fact that we're in a channel up pattern, which most people do. But if you really want to scalp back and forth, get quick trades here and there, the ideal situation would be buy every time it hits the support area on an uptrend and sell every area it hits a resistance on the uptrend. Same thing with a channel down pattern, okay? If you were trying to short a stock, you would do this, but also this is a key if you're in a position, let's say up here, and you see it start to fall, but you want to see what actually happens to it. This would be a clear sign to sell out of the position, because we're in a channel down pattern. Because the stock keeps on hitting this resistance on the top and can't break up to the upside, it keeps on getting rejected right here in this blue line. It keeps on getting rejected and can't break out. Because of that, you have to exit out of your position if you're trying to go long. If you're trying to go short, this is ideally the perfect situation, because it's the same thing as an uptrend, except it's the opposite. It's a downtrend. So this is our support area right here. It bounces. It does have a support, but it hits this resistance and it keeps going lower, lower, and lower. And as you can see, the price is going lower and the stock is downtrending within this channel and can't break out. And until it breaks out to the upside and holds that area, it's a downtrending stock and it keeps on downtrending. So you can map these out, and that's when you can figure out where a stock is headed and whether or not it started its reversal, because if it keeps on downtrending, it hasn't reversed yet. So there's no point in buying into a downtrending pattern stock if you want to go long term with the stock. Lastly are some important day trading and scalping patterns. Now we're going to walk through these each because they're very hard to find on actual charts. So you have to really be watching these, study these types of patterns. But let's go through these different types of patterns and see. So we have the reversal patterns, okay? So these types of patterns are stocks that move to the upside, hit a resistance, back down to support, hit a resistance a second time. Double resistance normally causes it to fall down to the downside. Now it can reverse and break out to the upside, but for the most part, if it's a double resistance, that means it's a strong area of resistance, and because of that, it falls to the downside. So this would be if you're going short, you take a position here, and you take your profits down here. Same thing, similar here. Head and shoulders, breaks out, goes to the upside, hits resistance, breaks through resistance, comes back down, tests that first resistance area. Okay, so now it's testing this support because it broke the support after a head and shoulders. It breaks down to the downside. You take a position here, sell out here. Rising wedge is similar to an uptrending channel. It breaks out and it's in this channeling wedge, but it gets squeezed out. And because of the fact that it's a rising wedge, it breaks down to the downside. You take a position once it breaks out of that channel, okay? So it'll break that channel to the downside and fall down to its target price right here. Now, these are all bearish type of patterns, so that would be if you're trying to short stock and make it go down. But we have bullish patterns too, which is a double bottom. A double bottom is one of the most common and best used technicals out there. A double bottom is when a stock is free falling down, okay? Stock hits a bottom, bounces up, bounces again to that same bottom area. Because it bounced twice, like I said, it has a potential to break out. And if it does break out of this resistance right here, boom, you have an easy target entry and a target right here. So you break out and take that position. Inverse head and shoulders, same thing as head and shoulders, except it's the inverse way. Boom, you get the head, you get the shoulder, head, shoulder, boom, and you break out of this resistance area, which is, they call it the neckline, and you break out of the resistance and take the position. Falling wedge is the same thing as a rising wedge, except the exact opposite, in the sense that it is in a wedge that's getting squeezed and it is downtrending. But once we break out of this wedge and break out to the upside, this is when you take a position. Falling wedge is, this is when a stock is falling, same thing as a falling wedge in this pattern, but it already broke out to the upside, and in this scenario, it's downtrending after, and then it breaks out again. So this normally happens if a stock breaks out, like a day trading stock breaks out, stagnates for a little bit, and then before it breaks out again, you watch to see if it breaks that area of resistance right here, which would be the downtrending, the falling wedge pattern, and then if it breaks out, you take the position there. Bullish rectangle, this is a nice pattern to trade off of. This is one of those basically channel patterns that it breaks out, it stays stagnant, it trades in a mini channel, and you see that it keeps on hitting resistance multiple times, support multiple times. Boom, you take an entry here. You have to stop out here. You have to be quick cutting losses on some of these patterns, but you take a position here and you let it ride out once it breaks over this resistance. That's a bullish rectangle. And then a bullish pennant is similar to a rising wedge in the sense that it runs up, gets squeezed again inside of this pattern right here, and if it breaks out of this resistance right here after we draw this triangular pattern, it breaks out, you take that position after the break and you let it ride up. So yes, these were a lot of different patterns. We have our bearish ones, we have our bullish looking ones, and then we have overall these are bullish kind of patterns too. But they have the reversal patterns and then their continuation patterns. More types of trading patterns we have down here, which would be the rising wedge. This is a very, very common one. I like this one. So this is one if a stock gets beat down to the ground, finds a bottom, and then starts making higher highs. Every time a stock makes higher highs, you see this rising wedge. But this one also will fall down to the downside, and this is right here with the rising wedge. You can see that if it does break down and out of it, it can fall lower. It's a fake breakout. Bearish rectangle is another bearish one, falls down, stagnates for a little bit, can't break through this resistance and falls down to the downside. Bearish pennant, same thing, gets stuck in this channel wedge, this triangle right here, and it can't break out. And you can see these would be like candlesticks are basically getting smaller and more tight squeezed, and because of that, it breaks down to the downside, and you would take a short position there. Ascending triangle, they show it, you could go both ways, which I agree with. I like ascending triangle patterns. It's basically like a channel up. You could take an entry if you see a breakout to the upside, or take an entry if you see a break to the downside, depending if you're going long or short. This one's a very, very good pattern. You definitely should study this. Try and map these out on your trading platforms. Go right now, find one of these, any of one of them that you really, really like, and just map it out, trying. It's, again, not going to be perfect because they're stocks. They don't trade perfectly inside of the channel, but for the most part, you can find some of these patterns, and they really do go true to the way that the pattern trades. But these I like because they could go either way. So an ascending triangle is normally bullish. A descending triangle I normally see as bearish. And like I said, you get squeezed out and you either move it to the downside or to the upside depending on which way it breaks out. And then a symmetrical triangle is one of the most common ones. And you see it's literally a stock that is huge candlesticks moving up and down, but slowly starts to lose that momentum and just gets squeezed out. And eventually it'll get squeezed either to the upside or to the downside. Guys, there was a lot of scalping and day trading patterns on this chart, so definitely go back through and read some of these, read up on how they trade. These are short-term types of trading patterns, these ones right here. Now with the resistance and the support and resistance and channel patterns, like the channel down and the channel up, these are more longer term. You can use these as short-term trades too, but these are more if you're going for a day trade, a swing trade, or even for a long-term investment. You're trying to find the best time to buy this long-term investment, which is NVIDIA right here. I just realized it's in video. I just found this image online. You can see that if you're trying to get in for a long-term stock, you buy near this support and you buy the dips and let it ride up. So like I said, these channel patterns and everything are really, really important. You can use all these different trading patterns, whether you're day trading, swing trading, or going for a long-term investment. hopefully this video was educational and hopefully you guys learned something from it. Definitely let me know down below in the comments if you guys have any questions, or DM me on my Discord server. Guys, hopefully you enjoyed this video, and I'll be back with PowerPoint slide session 4 very soon. Thanks, guys.